Good morning. You are watching a live daily market outlook for Friday, 4th of May 2012. We are at the end of the week and just ahead of key release for this week, U.S. non-farm payrolls that are due later today, with most of the currencies holding the neutral mode, awaiting the release of the U.S. jobs data to see what will be the signals of for the U.S. economy, whether further contraction or some more signals for the possible expansion of the economy. As previous releases from U.S. were quite mixed, with some positive and some negative things, but overall picture from both sides of the Atlantic are still grim, and the rather negative outlook keeps the investors cautious at this point. The employers in states are likely increased hiring in April, although not enough to lower the country's 8.2% jobless rate, keeping pressure on President Obama ahead of his November's re-election. Likely employers added approximately 170,000 workers, as this is the forecast for today, to their payrolls last month, up from the March print of 120,000. That would increase, that would reduce fears the economy is losing momentum, but it also could dampen hopes that a stretch in a strong winter hiring signal a turning point for the economic recovery. The economy is still growing, but gradually, according to the comments of analysts, and hiring is coming back into line with what you would expect with the sluggish growth. Analysts said the Labor Department will release the April's employment report today at 12:30 GMT, with the report which regularly sets the tone for financial markets around the world. Could also rattle nerves at the White House. Weak growth and the high unemployment create a formidable headwind for Obama, who entered office during the darkest days of the 2007-2009 recession. Also, the single currency remains under pressure, despite the current near-term sideways movement and consolidation, as the bloc currency is set for the biggest weekly decline in a month amid the concern leadership changes at elections in France and Greece. This weekend could derail the region's austerity efforts. The 17-nation currency was 0.3% from an almost 2-year low versus the British pound, before a private report that might confirm the euro region output of services and manufacturing shrank for a third month. The dollar index was poised for a weekly gain before U.S. data forecast to show employment increase last month in the world's biggest economy. Analysts said that markets are concerned about what the new leaders will do, and the euro demand might see a more negative impact because of some uncertainties ahead. The biggest loser from in past 24 hours was crude oil, as it currently trades near a 2 weeks low, and heads for a weekly decline, worse than forecasted U.S. economic data and Europe's outlook stoke speculation. Fuel demand worldwide might drop. The futures for June crude oil dropped from a peak of a couple of days ago at 106.41, currently attempting at $102 per barrel. Well, is our technical support just below this level, and the more significant levels at 100 and 100.67, the recent low posted on the 10th of April, with the extremely negative tone on the technical outlook for the oil, threatening possible even possible retest of key support at $100 per barrel. Also, yesterday's comments from European Central Bank after a meeting of the ECB in Barcelona, when the decision was as widely expected to keep the rates and for at 1%. The president of the European Central Bank left the option for further stimulus if the economy continues to deteriorate, as investors await the outcome of elections in Greece and France. While policymakers didn't discuss lowering interest rates at yesterday's meeting, President Draghi pointed the new growth and inflation forecast next month that might change the ECB's policy stance. Uncertainty about the commitments of future leaders in Greece and France to fiscal reforms, paired with the worsening economic data and renewed tensions in financial markets that might force the ECB's hand. There is a significant downside risk to the ECB growth outlook, one of the comments from analysts, with the other one saying Draghi indirectly hinted at next month's ECB meeting, when the bank will publish a new projection. Since the ECB may lower its growth forecast, the rate cut, this discussion will stay with us. Austerity measures aimed at stemming the debt crisis have pushed euro area economies from the Netherlands to Spain back into recession, and might embolden Greek politicians who are challenging the country's commitment to spending cuts. ECB officials who have flooded financial markets with more than 1 trillion euros to avert the credit crunch have signaled they are reluctant to do more for now, as they press government to enact reforms. From today's calendar, apart from the U.S. non-farm payrolls, some other indicators are due to release before. At 7:53 GMT, we have German services PMI for April that are so far expected to stay unchanged at 52.6, following our services PMI from Eurozone 5 minutes later, also forecasted unchanged at 47.9. 9 o'clock GMT's Eurozone retail sales for March, no change for today, with minus 0.1 this decrease of the month of February. And finally, the U.S. non-farm payrolls due at 12:30, approximately 170. Our forecast is 176,000 new jobs expected to show on today's release versus 120,000 of the previous month, with the unemployment rate, according to forecasts, expected to stay unchanged at 8.2, as well as average hourly earnings for month of April at 0.2%. Take a quick look now at the markets and see the latest movements with the currencies and commodities. As always, starting with euro, the near-term price action is entrenched within a narrow range and in sideways mode after hitting a fresh low at 130.94. That was a brief break of 131 handle as a part of the broader pullback from a recent peak at 132.82 posted on 1st of May. That so far retraced over 61.8% of the initial rally from 129.93 to 132.82. The spike low set 130.92 with the price quickly recovering towards 131.30.50 zone, where it's currently moving. Negative tone dominates on the short-term outlooks, with the downside still vulnerable for possible further losses and a possible extension below 131. That is our strong support. Might open next levels at 130.68. That also marks the daily Ichimoku cloud base, as well as 130.56 low of 18th of April, ahead of a more significant 130 zone that marks the past 2.5 months range floor, and very strong support, as several attempts lower were contained at this level. And the big risk will be seen on loss of 130.00. That will signal a break of the recent range that lasts from beginning of February. Basically 3 months range and open way for possible extension down towards 126.22, a yearly low posted in mid-January. With the interim support at 128.72, strong support 9th of January 2011, and the 11 low, as well as 129, pardon, 9th of January 2011 low that comes before the 126.22 yearly low. As said, negative tone still on the short-term charts, as bearish crossover of 20 and 55 days exponential moving averages keeps the pressure on the downside, with the current consolidation being capped at 131.80, just ahead of 132.00. That is our key barrier and caps the upside for now, and only break above 132 would provide near-term relief and avert immediate downside risk. Today's NFP release, of course, will give us more clues and more define the short-term direction for most of the instruments. As mentioned at the beginning, most of the currencies moved in the neutral mode, sideways mode, awaiting today's FOMC release, with sterling against the dollar holding still above 161.58 recent lows, where the 55 days exponential moving average capped the upside. However, a recovery attempt and brief break above the main bear trend line drawn of 163.00 through 162.37 high seems to be short-lived, as the pair fails to sustain gains, and 20 days moving average at 161.93 limited most of the upside attempts, keeping the downside still in focus. On the downside, loss of 161.58 current lows, where the pair was attempting to base. It seems it's likely going to be lost, as the current developments in the market are showing a more negative tone, and the pair started moving lower on the after opening of European markets. Will open next significant downside targets. First one, Fibonacci support at 161.15 and 161.00 is the round figure support, ahead of very strong and break point at 160.80 and 160.60 previous high that will confirm the short-term top at 163.00 and allow for a deeper reversal, with the 160.60 as 50% retracement and more significant 160.00 that marks a 61.8% retracement, as well as round figure support to be seen on a break of the critical support at 160.80, 160.60. A larger picture for cable is still firmly bearish, as studies on daily chart hold a positive tone, although being quite close to their extremes, with the current pullback seen corrective, as long as 160.80, 60 are holding levels holding the downside, and seeing a corrective ahead of a fresh attempt higher. 163 remains as a key barrier, and the break above this level is to open way for more significant gains, with 163.88 Fibonacci resistance seen next, ahead of 164.00 round figure support, and more far we have the trendline resistance at 165.80, along with the peak of 14th of August 2011 at 166.17. So basically above 163, the nearest targets would be 163.88 and 164.00, while set loss of 161.60 opens 161.15.00 and 160.80.60 as a break point. Dollar yen is still in the corrective mode. However, the current movement is seen as consolidation, with the price action in the sideways movements, currently with the range defined at downside by 80.00 and the upside at 80.60. So far 80.00 holds the downside as a part of corrective action of 79.63 with hourly studies currently in the neutral to negative mode, while 4-hour chart outlook shows improvement but break above 55 days exponential moving average currently at 80.50, and the recent peak at 80.60 is required to confirm the current extension of the current near-term recovery of 79.63 and open more significant levels at 81.00 zone, where is also the 61.8 retracement of the latest down leg from 81.77 to 79.63. Broader picture, however, keeps this firm bearish tone as the pair continues to channel lower, and all upside attempts capped by a bear trend line drawn of 84.08 peak of 21st of March 2012. As downside so far holds has been contained by 90 days moving average that currently stands at 79.80. Loss of this level would trigger further extension. 79.52 is the post-intervention peak from October 2011 as the next target, and 79.00 as a round figure support ahead of previous highs at approximately 78.2030 zone. Also, where is 200 days moving average on the daily chart, that would be target in case of loss of 79.52 and 79.00. On the upside, 81.00 along with the Fibonacci resistance, it's a trendline barrier, and the break above this level would provide the short-term relief and open way for next strong static resistance at 81.77, 20th of April 2012 high. Dollar Swiss is also posing after a bounce of 90.41 low of 1st of May, peaked at 91.72. This was a spike high of 3rd of May, with the attempt so far succeeding attempt to break above the main bear trend line of yearly highs from 95.90 zone. Today's weekly closing actually above this level that is currently at 91.27 would be quite supportive for the pair and will allow improvement of the currently I would say neutral structure on the daily chart, and the open way for a stronger recovery as the range narrowed, forming a triangle on the daily chart with current break above required to sustain break above required to define the fresh trend. The immediate barrier above is 91.88, 90 days moving average ahead of 92.00, and the more significant 92.50 level peak of 16th of April 2012. On the downside, the trend line support and triangle support stands currently at 90.64 ahead of a static support low of 1st of May at 90.41, and loss of this level is to open more significant downside targets 90.00 and 89.30. Daily, the 4-hour chart studies are holding still holding positive tone as the 20 days moving average crossed above 55.1 and underpins the current advance. The pair needs to hold above 91.00 in order to keep the focus higher, with break of 91.70, also Fibonacci resistance to open the next levels 92.00 and 92.50 as our main upside targets. As said, gold remains under pressure in the past couple of days after hitting high at 1671, unable to regain the previous highs and strong barriers at 1680 and 1700 zone, with a brief break below the main bull trend line drawn of 1522 low of 29th of December 2011. Keeps the short-term focus at the downside, with immediate targets at 1524.23, double bottom of 23rd and 24th of April, and more significant low at 1612 low of 4th of April now coming in focus, as the upside there was capped by trend line, bear trend line drawn of 1725 level. Very significant resistance zone now stands at 1680, 1700 levels, along with the 200 days moving average, and basically only break above these levels would improve current negative structure. For now, negative outlook on the larger picture keeps focus at the downside, with loss of 1623 and 1612 to open 1600 as a round figure support, and more significant double bottom of 25th of September 2011 and 25th of December 2011, 1532, 1522. That is key medium term support, loss of which would be quite bearish for gold, as it is in the yellow metal is in downtrend of 1920, 4th of September 2011, a record high of gold, and since then is in downtrend. That so far hit 1522 low of 25th of December 2011. And finally, quick look at crude oil, that, as mentioned at the introduction, the biggest loser of this week after significant gains that peaked at 106.38 were quickly erased in past few days. Sharp decline. The pair is currently attempting at 102.00 ahead of 101.82 low of 23rd of April. That will open way for a more significant support of 100.67 10th of April low. Daily chart shows negative. The studies on the daily chart now weakened after upside rejection at 106.41, and the current sharp decline with the loss of 102. 101.80 support required to confirm the negative structure, and look for test of 167 and possibly key psychological support at $100 per barrel. As said, concerns about possible lower demand for the energies worldwide keeps the investors very cautious, and the recent drop in the oil price is the direct result of these fears. Negative tone on the broader picture of crude oil persists from 110.53 spike high of 1st of March 2012, with the downtrend defined by lower tops at 108.68 and the current one at 106.41. However, we need to see the break below 167 in order to confirm. A larger pictures outlook still shows the part of the crude oil in the uptrend, with the recent rally, medium-term rally from 2nd of October 2011 from 74.94 that peaked at 110.53, still being intact, with the recent pullback seen as corrective, and the key supports at 167 and 95.43 as well as 92.76. That was all for today. We are back on Monday at the same time, 7:00 GMT. For all those that connected later and missed any part of the presentation, you can find recorded version in the YouTube. Windsor Brokers page is called Windsor Brokers Forex, where along with this outlook you can find the technical analysis for most of major currencies and commodities. I wish you a nice day and very successful trading. Good luck.